Good afternoon, everyone, and thank you for joining us for our presentation of 2020 Employee Benefit Plan Hot Topics and Understanding Employee Benefit Plans in the CARES Act. Today, we'll be discussing some of the latest developments regarding employee benefit plans, including best practices in documentation and record keeping, cybersecurity, how the CARES Act will affect your plan, and best practices on selecting service providers. These are all topics identified this year by the AICPA as key issues that will affect employee benefit plans. I am Nicole Belding. I'm a senior manager with FML, and I'll be your MC for today. I'm joined this afternoon by three of my colleagues from FML, all from our Audit and Assurance Services practice. Today we have Jana Reiser, Senior Manager, Mary Wazensky, Audit Director, and Matt Soroka, Audit Director. Together, we have over 50 combined years of experience specifically related to employee benefit plan audits. As a firm, one of FML's specialties is employee benefit plan services. We are a member of the AICPA Employee Benefit Plan Audit Quality Center. We audit over 75 plans each year, including defined contribution, defined benefit, and health and welfare plans, which puts us in the top 5% of CPA firms nationwide who service employee benefit plans. We're excited to be joined today by presenters from the Horton team, represented by Barnaby Horton and Trevor Glasgow. Barnaby is a non-practicing attorney recognized nationally for planned fiduciary excellence, a 4-year winner of the Financial Times Best 401k Advisors, 3-time winner of Plan Advisor Magazine Top Retirement Plan Advisors, and in 2018, the Horton team was named the #2 team for Plan Advisor Excellence by National Association of Plan Administrators Magazine. Barnaby is a defined contribution investment consultant, the only Merrill designated consultant in Connecticut. He is a certified investment management analyst, having completed the 3-part exam series and executive coursework at both the Wharton School of Business and Yale School of Management. Both Barnaby and Trevor Glasgow are legacy Merrill retirement benefits consultants and have completed the extensive training at UCLA Anderson School of Business and are certified plan fiduciary advisors. Barnaby and Trevor represent the Horton team at Merrill, a Bank of America company. This team is made up of highly trained and credentialed professionals to handle employee benefit needs. The Horton team is designated by Bank of America as the only employee benefits consulting team in Connecticut and only one of 4 in Southern New England. We also have guests today on the call from Merrill, a Bank of America company, the Cerullo-Sullivan team. We have Michael Cerullo, Ed Sullivan, and Richard Sullivan. Before we begin, a couple housekeeping tasks. We would love to answer your questions regarding the topics to be presented today. Feel free to input any questions into the chat box as you have them. We'll do our best to address most questions at the end of the presentation, and if there's any we can't get to, we'll follow up after the presentation. I'll hand it over to Jana Reiser at this point. Jana?
Thank you, Nicole, and thank you all for joining us for today's webinar. One of the challenges around benefit plan administration, which is becoming even more prevalent with the COVID-19 pandemic, is the plan record retention. Before we begin discussion around the importance of record retention, let's define the plan record categories. The first one is reporting and disclosure. Those are forms that are filed with government agencies like your 5500, etc. The second category are the benefit determination records, which is the information about benefits and eligibility for plan participation, investment balance details, personal information such as medical health records or addresses and benefit payment information, etc. The third category are the accounting records, which is the information for calculations, measurement, processing, and communication of plan financial information. Lastly, we have plan governance records, and those are the documents that memorialize decisions like plan documents. Plan records are usually stored by various custodians. Next slide, please. Thank you. So plan records are usually stored by various custodians, from plan sponsor to record keeper to administrator and other custodians. The custodians also store the records in various forms, whether they're in paper or digitally. In the industry, we've been seeing a switch towards digital records, which is more prevalent with the COVID-19 pandemic. Actual record retention is governed by ERISA and DOL, sections 107 and 209. Section 107 requires for records that support filings to be retained for 6 years from the filing date. Section 208, however, is a lot less defined in terms of the duration of record retention, and rather requires that employers store records for enough time in order to support benefits that are being paid out or will be paid out in the future. Essentially, Section 209 implies that records should be stored indefinitely, which is why a lot of individuals and organizations are currently switching to storing records electronically. Electronic document retention is regulated by HIPAA. Next slide, please, Frank. Thank you. So electronic document retention is regulated by HIPAA as well as the DOL. DOL considerations include that the records need to be available, meaning ready for inspection, legible, meaning readable, and controlled, which means that the organization should have controls in place to ensure integrity, accuracy, and authenticity of records. Now, legibility of records is actually a problem because a lot of times when companies transition to an online platform, they will scan in the documentation, but that quality of the scan needs to be maintained before the originals are destroyed. IRS actually has very similar requirements for plan record retention, and those are very similar to the ones of the DOL. With these many entities governing the record retention, there are certain best practices that we'll talk about on the next slide. So one of the questions we get frequently asked is, what are some of the things that we can do better, or what should we be doing in order to maintain a nicely organized plan record library? And so one of the things that we recommend is to first and foremost to implement a formal policy, which includes how organization reviews, updates, preserves, and discards documents. That policy should be approved by ERISA Council and those that are charged with governance. Secondly, in scenarios where a third-party organization is used, it is important to understand that the use of a service organization does not alleviate the plan sponsor's responsibility to retain adequate records. In such instances, the administrator should monitor service organizations' compliance with their respective retention policies. Next slide, please. Another good tip is when placed into a position when plan records are to be shared, whether they're shared with auditors or other service providers, is to share only the minimum required amount of data in order for them to accomplish a task. We also recommend that you use encrypted email, secure portals when sharing information, as well as try to de-identify the data, such as truncate social security numbers or employee IDs, etc. Next slide, please. Availability of records is not only important for privacy, security, and compliance perspectives, but also can drive an audit opinion. Generally speaking, plans with over 120 participants are required to be audited, and an auditor can issue a qualified audit opinion, meaning they were unable to obtain certain evidence which had a material impact to the plan, but overall was not pervasive. Or an auditor can also disclaim an opinion, meaning they were unable to obtain information which was both material and pervasive. To note, limited scope disclaimers of opinion are rather common and allowed in instances when investments are covered by a trustee. Now I will hand it off to Mary Wazensky with cybersecurity.
Thanks, Yana. Good afternoon, everyone. I just want to say thanks for joining us today. And I had a lot of help to put this together from the team at Merrill and FML. So thanks very much, everyone. I'm going to talk about cybersecurity, and this is one of these really, really hot buttons. I think that in our world today, we hear often in the news, and it's really something we wanted to present on this because hackers and things, some of these attacks are getting worse, and we wanted to kind of bring up the highlights. One thing that, there's some risk factors I have listed here. As you know, most of you know, the electronic environment that plans operate in now, many things are electronic, especially as Yana had just said, even records now we're keeping electronically. And on these records, there's a lot of sensitive data. So, that the environment in which the plans operate definitely is at risk for a cyber attack. There's not really any regulations yet for cybersecurity purposes. So I think that's most likely in development, but right now the benefit plans are not regulated. A couple points I wanted to bring up on some interesting myths I thought. Some of us think that antivirus or anti-spam software might adequately protect our plan, but not necessarily. There's a lot of, you might have service providers that also provide services to the plan and also house some of the data. And so we look at these SOC 1 reports, but those reports also do not address cyber risks. It actually just addresses internal controls at the service organization. So I have a slide a little bit later about the SOC reports. So information at risk, when you think about a benefit plan, there's different types of data that are at risk. One is just personal information. So, the participant information, as Yana was just saying, we as, a service provider, we have encrypted emails, for example, and portals because there's social security numbers, there's employee demographic data, such as hire dates and birth dates. All of that information, is housed as part of the plan data. And that's information that certainly is at risk. One thing here, the second bullet, I'm really interested in lately, just because of some webinars and things I've heard about, is you don't think about it, but participants are logging on their trustee or TPA website and they're entering in their direct deposit information. I just spoke to a client actually this morning that had an issue with their payroll system where they had a phishing email and one of the participants thought it was from the 401k plan or payroll provider and entered in direct deposit information into a fake email, and someone stole some money. So that's how important it is when you're entering banking data, account balance data, or certainly your own direct deposit information. And so, you want to be able to protect your participants from a cyber attack. The third item here is really another interesting point on healthcare information, which is related to HIPAA in a certain fashion when we think of HIPAA and healthcare regulations. But really what hackers can do is if the plan includes some medical benefits or, HSA or other information, prescription information, there's actually been attacks where hackers will go in and steal prescription information and be able to take prescriptions out on someone else's account. So that's how important this cybersecurity issue is becoming and the different types of information at risk. The consequences of a cyber attack can really be astronomical, and it's really hard to imagine, the impact that could happen just on a benefit plan, even in itself. The cost of these attacks, whether, at first you have to detect exactly what was stolen. And that can be, hard to detect. Sometimes that period of time before you realize that there's a hacker or you've had a cyber attack on your benefit plan or even your organization's general ledger, you might not even notice. By the time you've identified the attack, there could be significant monetary losses. And as I just said, these losses could be to your participants in the plan, whether it's through medical benefits or direct deposit information. Their beneficiaries, if they've entered beneficiary data into the plan information. This can cause, major operational disruption, not only to your business in general that you're running, but to the plan, everything at a halt. And it can be a very stressful and uncertain time. So you certainly want to try to plan for cyber attacks. And, we always think about, I think about anyway, even like we've heard about Target and things like that, who have suffered a cyber attack and the damage to reputation. If your employees or participants, you had a cyber attack and they've lost, funds or money, that's, that reputational damage could be lasting. Also, if you're a plan fiduciary, I have some plans that I work on where the officers are actually the trustees. They also could be liable as a fiduciary and responsible person in the plan to restore losses. And you certainly wouldn't want to have any consequences of that nature. Next slide, please. So speaking about plan fiduciaries, so if you're managing a plan and you are the fiduciary or an officer of the company, you certainly want to kind of have a plan in place to address a cybersecurity breach. One thing is controls, obviously, processes and controls to restrict access. And so when we think about, the SOC 1 reports, those are, controls at the service organization, of course, but you as the person that's sponsoring the plan and entering the data into the plan that goes ultimately to that service organization, you're responsible for preserving and securing that data and for the accuracy and completeness of that data. And those are these things that are kind of people are talking about lately as far as user controls. And those are items that there's touch points at the company and you are responsible for those items. So once it gets to the service organization, then their controls, are in place to maintain the data, but ultimately the company or sponsor is, responsible to upload accurate data. We recommend understanding how the service providers do store and protect data. That's actually cybersecurity is addressed in a SOC 2 report. The SOC 1 is really about internal controls over financial reporting, as I had mentioned. But if I was, with your TPA or trustee, I would want to understand how were they securing data? What protocols are in place? I actually had an audit last year with a TPA who had a breach, and they failed several controls. And if my participants' data is in that plan and their funds are being managed by that service provider, I would want to know how they're addressing that issue and what the repercussions could be. Also, certain states do have some responsibilities for cybersecurity. So depending on what state you're in, you might want to just check out to see if there's any state regulations. Cybersecurity can also be part of your disaster recovery plan in general for your business. So if your business has a plan, you might want to just address how the 401k plan or any kind of benefit plan, whether it's a DB plan, is secured as part of the disaster recovery plan. So this is just a last point here. I really want to just kind of talk about the significance of what's in each SOC 1 report. And I do recommend to my clients that they do take a look at these reports. It's important, as I said. I had a client last year, that had the breach in their TPA, and they took precautions and started to understand what was going on at their service providers. So the SOC 1 report really addresses the plan's internal control over financial reporting. It doesn't go into this broader concept of cybersecurity. If you want to understand what protocols are in place as far as cybersecurity for your plan, you would want to request from your service provider the SOC 2 report. And the SOC 2 is a report at a point in time, but it does address cybersecurity controls. And that's something we would recommend that you take a look at. There's lots of considerations here. So if you have any questions on cybersecurity, we'd be happy to address them at a later time. And now I'm going to hand it off to Barnaby Horton, who's going to talk about the CARES Act.
Thank you, Mary. This is Barnaby Horton from the Horton team at Merrill Lynch. And the Horton team is a comprehensive team offering consulting and advisory and fiduciary solutions for defined contribution 401k clients, for defined benefit and pension plans. We also consult on executive compensation. This part of our presentation and the focus going forward on the HSA is going to be part of our comprehensive financial life benefits package that Merrill Lynch is offering to corporate clients nationwide. It includes employee benefits, as I mentioned, executive benefits, financial education, health savings accounts, and banking and wealth management services. Let's step back a bit to put this into context. I'm going to be on slide 3 for the Corona Coronavirus Aid, Relief, and Economic Security, the CARES Act. On March 27th, 2020, the CARES Act, which is the Corona AIDS Relief and Economic Security Act, was signed into law, passed by Congress and signed by the President. This was the largest rescue package in U.S. history. This package itself was $2 trillion worth of economic relief for consumers and businesses. It included support for small business, workers, families, healthcare systems, distressed industries, businesses, states, and municipalities. It was really just one piece of the savings, as many of you have probably read about in the papers. In addition to this being fiscal stimulus, there was also monetary stimulus that was offered by the Federal Reserve Bank. But focusing on the CARES Act, this expansive legislation has wide-ranging implications with changes to tax rules. These will be applicable to retirement plans and accounts that comprise a significant component of this act. So we're going to go through those in a little bit of detail. And in addition to addressing these retirement-related elements of the CARES Act, we're also going to address the IRS regulatory guidance provided in response to the coronavirus impact on the economy. I'd like to step aside for a few slides here and introduce my business partner, Trevor Glasgow. Trevor is a retirement plan consultant at retirement benefits consultant at Merrill Lynch. He works on the Horton team. He's a financial advisor, and he's going to walk us through some of the details here, particularly with provisions impacting IRAs and qualified plans, and then we'll come back and talk a little bit more about HSAs and other implications of the CARES Act on employee benefit plans. Trevor?
Thank you, Barnaby. And really what I wanted to focus on today were 4 provisions of the CARES Act that will apply specifically to qualified plans. The first 2 provisions you see on your screen in front of you are provisions that also impact individual retirement accounts or IRAs. We know in today's world that employees rely on employers for more and more knowledge, and in particular, HR departments. And so we wanted to distinguish and lay out 4 provisions that at this point are need to know information for anyone in the employee benefits field. So to dive into the first 2 provisions, required minimum distributions, or RMDs, for 2020 have been waived. So if we move forward on the next slide, RMDs have been waived for all types of defined contribution plans. So this includes 401ks, 403bs, and governmental 457b plans, in addition to individual retirement accounts. For 2019 distributions that may have been taken after January 1st, that were required to be made by April 1st, those have also been waived. RMDs that have already been distributed in 2020 may be rolled over. They just have to be subject to the existing IRS rollover rules. RMDs for inherited accounts have also been waived for 2020. RMDs to spousal beneficiaries that may have been taken in 2020 may be rolled over. And the catcher here is RMDs to non-spousal beneficiaries are not eligible to roll over. Important to note that the RMD waivers do not require any action from plan sponsors. These are mandatory waivers and are in place for 2020. Now, the second provision, and this is also one that affects individual retirement accounts, are coronavirus-related distributions, and in another abbreviation here is CRDs. So on the next slide, we'll walk you through some of the provisions of CRDs. In this case, this is an optional provision that you can choose to offer to employees. Now, the distributions must be taken after January 1st and before December 31st, 2020. So these are temporary relief provided by the CARES Act. The CRDs are limited to $100,000 in aggregate from all IRAs and employer plans an individual may have. Now, while they look and feel much like hardship withdrawals, there's a couple of tax benefits here that we want to make you aware of. The 10% additional tax that usually applies to distributions prior to age 59 and a half is waived, as is the 20% mandatory withholding from employer plans. CRDs may be repaid to an eligible retirement plan within 3 years, another important distinguishing factor of these. Individuals who choose not to repay the distributions may bring the taxable portion of the distribution into income evenly over 3 years from the date of the distribution. So they can spread it out over the course of the next 3 years. Now, who is eligible for CRDs is something that you need to be aware of. And the eligibility criteria is outlined on the next slide. An individual who is diagnosed with the virus, coronavirus disease 2019, by test approved by the Centers for Disease Control and Prevention, or who meets any of the following criteria can take a CRD withdrawal. The additional criteria are if their spouse or dependent has been diagnosed with such virus, or a few different financial hardships as outlined below. These include being quarantined, being furloughed or laid off, or having hours reduced, being unable to work due to lack of childcare, closing or reduced hours for a business owned or operated by an individual due to such virus or disease, and other factors determined by the Secretary of Treasury. So as you can tell, it's not just those who have been directly diagnosed with the disease, but there are some additional criteria that enable individuals to take distributions. When can you access funds? IRAs, they are available immediately. For employer plans, we mentioned that this is an optional distribution. So on the next slide, plans that choose to offer may elect to offer these prior to amending their plan. So amendments are going to be required, but not until the end of the 2020 plan year. They're not subject to hardship withdrawal guidelines. So I did mention they look and feel like hardships. However, they are not treated the same. A great benefit for employers is that they can rely on employee self-certification. So unlike hardships where you have to qualify that the hardship does take place, in this case, you can rely on the employee to determine that. Eligible plans are outlined below. Generally, most qualified plans are included. So 401ks, 403A, 403B, and governmental 457B plans. And in addition, CRDs are also available in money purchase plans and defined benefit plans. Now, what I want to do next is walk you through two additional provisions that impact, in particular, qualified plans. These have no impact on individual retirement accounts, and those would be loan relief. There's two different types of loan relief that are provided in the CARES Act, and defined benefit funding, which is also impacted. So if we jump forward to the outline of the loan relief for employer plans, this is another optional benefit, amendment to 401k plans. The legislation provides for two kinds of loan relief for plans that offer or add participant loans. In both instances, if the plan adopts one or both of these loan provisions, a participant must meet the same eligibility requirements listed above for coronavirus-related distributions. Now, the two kinds of loan relief that are available are first, a suspension of outstanding loan payment. So for eligible individuals, any loan payments due between March 27th, when the CARES Act was enacted, and December 31st, 2020, are delayed for 1 year. This even includes loans that predate a CARES Act. Any subsequent repayments of loans must be adjusted to reflect the delay and interest accrued during the delay. So you can suspend your loan payment until the end of the year. Again, this is an optional plan provision, and while there's no immediate action required on behalf of the employer, the plan amendment would be required by the end of the 2020 plan year. The second form of relief is the expansion of loan limits. We're seeing this as a popular choice to amend plans. In this case, if the plan sponsor chooses to do so, the standard loan limitation, which historically has been a lesser of $50,000 or 50% of a participant's vested account balance, that can be expanded to permit a loan for up to $100,000 or 100% of the participant's vested account balance. So again, another expansion of loan limits here designed to provide some financial relief for employees. Finally, I just want to address defined benefit plans. And on the next slide, you'll see single employer funding obligations due during 2020 are not required to be made until January 1st, 2021. It will include interest for late payments, but you are able to push those off until the beginning of next year. Under the bill, a plan sponsor may elect to apply the plan's funded status for 2019 in determining the application of benefit restrictions for plan years, which include calendar year 2020. This provides relief from the funding rules that require certain benefit restrictions to be applied if a plan's funded status dips below certain levels. So if the investment dip below certain levels, there's some relief there. And with that, I do want to turn the call back over to Barnaby Horton, who is portfolio manager on the Horton team. Barnaby is going to discuss two additional provisions that impact not qualified plans, but health savings accounts. With that, Barnaby, take it away.
Trevor, thanks. I want to address, just as we're winding down here, provisions of the CARES Act that impact health savings accounts, HSAs. As I said earlier, it's part of our financial life benefits package for executives, for key employees, not only in the 401k space or the pension and defined benefit space, wealth management, banking, financial education, but we do work with our corporate clients on health savings accounts. And so I thought it would be important to discuss at least a couple of areas where we've seen some provisions of the CARES Act impacting HSAs. So if we can dive into it, you'll see that telehealth and over-the-counter medication were some substantial changes that I think many of you will want to know about if you haven't already. But going into the details, provisions impacting health savings accounts, these are, as we know, health savings accounts are qualified high deductible, are part of a qualified high deductible health plan. These HSAs would be temporarily permitted to cover telehealth and other remote care services below the deductible, and for plan services for plan years beginning prior to next December 31st, 2021. This provision expires at the end of next year. During that time, during the next year and a half or so, telehealth and other remote care services will be considered disregarded coverage so that so the employees would not lose their HSA eligibility. And this fits a theme that we've been sharing with our clients on the new normal, relative to folks who, may not want to go to see their doctor or healthcare professional. This telehealth has really come on by storm, literally in the last 3 or 4 months, where it was prominent before. It's really become a big part of healthcare delivery in this COVID era. So the legislation also eliminates a requirement under the ACA, the Affordable Care Act, related to the purchase of over-the-counter medications with HSA funds. The ACA requires that in order to use HSA funds for qualified purchase of OTC medication for the individual, there must be a prescription. And obviously this would be for a spouse or a covered dependent. The CARES Act eliminates this ACA requirement and permits qualified purchases of over-the-counter medication with HSA funds without a prescription. And these changes apply to expenses paid on or after this year, so January 1st, 2020, and the provisions are now permanent. I would also indicate, as we see on the slide, that there are some additional prescription requirements that have been eliminated for Archer, MSAs, FSAs, flexible savings accounts, which folks might have, and HRAs. So, moving to the next slide, we want to talk a little bit about regulatory relief that's related to the coronavirus. As certainly in partnership with FML, many of you know that the federal income tax filing was extended to July 15th, 2020, and we're certainly seeing a pickup in activity of folks wanting 1099s. But they've also extended to July 15th of this year, so in just a little less than a month. You can contribute to your IRA for 2019 and also your HSA. And the additional 10% income tax due on 2019 premature distributions of IRAs for employer plans. The 2019 employer qualified plan contribution due date. And so the HSA for the that's offered through a qualified high deductible health plan. You can see some of the co-insurance exemptions here on the slide. The final piece that probably didn't get a lot of headlines was the FEMA declared disaster. And for defined contributions plans that have adopted the FEMA, the Federal Emergency Management Agency, FEMA declared disaster hardship withdrawal provision, participants in the plan whose principal place of employment or principal resident is in a state where FEMA has made a major disaster declaration may be eligible for a hardship withdrawal from the plan. There are currently several states that have a coronavirus major disaster declaration from FEMA, and plan sponsors can certainly check on a date, an update from on the FEMA website. I'll also note that defined contribution plans are not required to provide hardship withdrawals, and when the hardship withdrawals are made available, the plan can limit the circumstances under which participants will qualify for that withdrawal. So if we go to the next slide, it's, this is all a work in progress. We're monitoring here at Merrill Lynch through our regulatory and legislative teams. We also monitor the markets through our Chief Investment Office. And all I can tell you is to stay tuned, stay close to your advisor at FML, stay close to your advisory team at Merrill Lynch, because there's more to come. You can see it right here on the slide. I mean, the federal government is currently finalizing the details and protocols about a lot of activity, whether it's PPP, whether it's the employee benefits program, and there's even talk of additional legislative packages in the in process now. So we will continue as advisors to monitor developments and provide updates as applicable. And just know that we would like to be your #1 resource for that type of content and information. So that ends the employee benefits part from the Horton team here at Merrill Lynch. I want to turn it over to Matt Soroka, who is the Director of Assurance and Advisory Services at FML. Matt, take it away.
All right, thanks guys. Hi everyone, I'm Matt Soroka. As we close out this presentation, we want to remind plan sponsors and fiduciaries of their responsibility to take the proper care in hiring service providers and remind them the importance of an audit. Now, when it comes to hiring service providers, whether it be a trustee, plan consultant, or an auditor, there are a few qualities that they should prioritize. Experience, or how long that they've been in the industry in working with benefit plans. Number of current clients or employee benefit plan audits that they do. And affiliations that they have, which provide service providers with additional resources if they ever need it. Ask about how responsive they are in case fiduciaries have questions or issues. The service provider software, which may indicate their reporting capabilities or format of the deliverables. Training and benefit plans that they are required to have. Compliance, like, for example, if the auditors are audited themselves by other agencies or organizations, this increases the chances that the work that they do is of higher quality. And finally, references, or the service provider's network of individuals or other companies that they can lean on if they find themselves needing consultation on anything. As a reminder, audits are required by the government, generally for plans with 100 or more participants. The audit reports are attached to the Form 5500 filings. Form 5500s, which are required by law no matter how big or small the plan is, are generally due July 31st for calendar year ends or October 15th if extended. And as of today, no due dates have been extended as a result of the CARES Act, other than for a few due dates from April through June 2020. I think that new due date is now July 15th. Just as it is with cybersecurity, as Mary had previously mentioned, hiring a good plan auditor is a fiduciary responsibility. And hiring a firm with little to no experience or quality goes against ERISA. Risks to fiduciaries include them being liable on a personal level, the DOL rejecting plan filings, and similar to what Yana already touched upon with the inadequate plan records discussion, daily monetary penalties. For some tools and resources that might be useful to plan sponsors or fiduciaries regarding hiring a plan auditor or fiduciary responsibilities, see the links in this presentation from the American Institute of CPAs and the Department of Labor. Thanks so much for taking the time to listen today. So Nicole, do you want to close it out?
Absolutely. Thanks, Matt. And thank you to all of our presenters for today. At this point, we have a little bit of time for questions. If anyone has them, there is a chat function in the right of your screen to enter any questions you have. I'll give everyone just a moment to enter any questions if they have them. Okay, at this point, I don't have any questions coming in, but we provided our contact information at the beginning of the presentation. If you have anything, feel free to reach out to any one of us. We are happy to help in any way we can. If nothing further, this concludes our presentation. As I mentioned at the beginning, we'll be sending out a copy of the slides as well as an audio recording of the presentation via email to all the attendees. On behalf of FML and Merrill, a Bank of America company, we thank you all so much for joining us today. Thank you.